Hey everyone, and welcome to this deep dive. It's all about capital allocation and cost control. Trying to make those labor costs work for you and really getting the most out of every dollar you spend.
You got it. And the source material we're looking at today really emphasizes that it's not just about cutting costs.
Yeah.
It's about being strategic, making sure your money is, working as hard as you are.
Exactly. So let's break it down. Let's start with labor costs, because I think we can all agree that's often the biggest expense for any business.
Definitely. And the source dives into this whole concept of workforce planning and scheduling. It goes way deeper than, just making sure you have enough people on hand. It's about using data, predicting how much staff you'll actually need.
That's interesting. So kind of like anticipating demand.
Exactly. Demand forecasting. They use things like historical sales figures, to figure out staffing needs. Imagine a retail store, Black Friday. They can use last year's data to know, okay, at 2P meters, we need this many cashiers, this many people on the floor, and at 7P meters, we'll need even more.
So no more like frantically calling people in at the last minute or having customers wait in huge lines.
Exactly. It's about efficiency and happy customers.
Yeah.
Of course, it's not always that predictable, right? Things change, demand fluctuates.
Yeah, for sure. What about those situations where you don't have a Black Friday every week?
Well, that's where flexible scheduling comes in. Take part-time roles, flexible hours, on-call shifts. It's about being able to, adapt to the ebb and flow of the business. And then you add in shift optimization, making sure people are strategically placed to minimize downtime. You start to see some real savings.
Okay, I'm starting to see the bigger picture here. We're talking about a more responsive workforce.
Yes, and a more efficient one, too. Think about 247 operations. Even small improvements in scheduling can have a huge impact because time really is money in those situations.
Absolutely. Okay, so we've got the right people scheduled at the right times. Now, how do we make our workforce even more efficient? The source material mentions cross-training and multi-skilling. What's that all about?
This is where things get really interesting. We're moving beyond rigid job roles. Cross-training basically gives employees the skills to handle a wider variety of tasks, and job rotation lets them experience different departments. Not only does this create a more flexible workforce, it can actually boost employee engagement too. People tend to get bored doing the same thing day after day.
Yeah, totally makes sense. It's like creating a team of multi-talented individuals ready to tackle anything.
Exactly, and technology plays a big role here too.
Oh, right. I saw that mentioned in the source.
Yeah, online platforms, virtual simulations. These tools make training so much more efficient and accessible. Employees can learn new skills faster, more effectively. Imagine a manufacturing plant where workers are trained to operate multiple machines, not just one.
Interesting. So if someone's out sick, production doesn't completely stop?
Exactly. You've got that built-in backup.
Okay, let's talk about the elephant in the room. Automation and technology integration.
Yeah, the big one.
Some people are afraid of it. They see it as a job killer. Others say it's the future. What's the take here?
Well, the source acknowledges both sides. There's no denying that automation can displace some jobs, especially those that are repetitive or dangerous. But it also creates new opportunities, pushes us towards those higher skilled roles. Think about a robotic process automation, or RPA. It uses software bots to handle things like data entry, freeing up humans for more complex tasks.
Yeah, the source mentioned warehouses using robots to manage inventory. That's pretty incredible, the speed and efficiency they must gain.
Yeah, it's mind-blowing, but it does raise concerns about jobs. That's why retraining and upskilling programs are so crucial.
Right, helping those displaced workers transition into new roles.
Exactly. Roles that require creativity, problem-solving, critical thinking,
Sure.
those things that are harder to automate. And who knows, maybe those new roles will be even more fulfilling.
Okay, makes sense. So automation needs a human-centric approach to really be successful. What about outsourcing and temporary labor? Is that a cheap shortcut, or can it actually be a smart move?
It definitely can be smart if you use it strategically. Outsourcing non-core functions lets you focus on what your business does best while leaving specialized tasks to the experts.
Like a small business outsourcing their IT or payroll?
Exactly. They get top-notch service without the cost of a full-time department. And temporary labor can be a lifesaver during those peak seasons, gives you the flexibility to scale up or down as needed.
Like a retail store hiring extra help for the holidays?
Exactly. It just makes sense.
Yeah.
So we've covered a lot of ground here on optimizing labor costs. Now let's dive into how to review those expenses, making sure we're really getting the most bang for our buck. It's not just about cutting costs. It's about scrutinizing every expense, finding opportunities for improvement. It's like a financial health checkup for your business.
I like that analogy. So first up, regular expense audits and benchmarking. What's the key takeaway here?
Regular audits, they help you spot inefficiencies, potential savings. Maybe you're overpaying for utilities or you've got a subscription you don't even use anymore. And benchmarking is crucial too. Comparing your expenses to industry standards gives you a clear picture of where you stand.
So you're essentially comparing your financial fitness to others in your field. I like that.
Yeah, it's a good way to think about it.
Yeah.
And then there's negotiating with vendors and suppliers. That's where you can really make some headway.
Okay. Any insider tips there?
Well, supplier consolidation is big. Working with fewer suppliers can often get you better pricing and streamline logistics. And don't underestimate the power of strategic sourcing. It's not just about the price tag. It's about choosing partners based on quality, reliability, even shared values.
Right, so it's about building those long-term relationships.
Exactly. It's a win-win. Now let's talk about something that's good for both the planet and your wallet. Energy and resource efficiency.
I love it. Saving money and being eco-conscious.
Right. It's the best of both worlds. The source recommends things like energy audits, identifying areas for improvement. Simple changes like switching to LED lighting or installing motion sensors can have a surprisingly big impact on those energy bills.
And water conservation too, right?
Oh, absolutely. Low-flow systems, rainwater harvesting, even just fixing leaky faucets, it all adds up.
It's amazing how many small changes can make a big difference. What are some other low-cost ways to implement resource efficiency?
Oh, tons of options. Optimizing those heating and cooling systems, recycling programs, encouraging employees to turn off lights. It's about creating a culture of sustainability, making it a part of everyday operations.
Okay, so we've tackled energy and water. Let's move on to another big one, travel and operational expenses.
I feel like there are so many ways to cut costs there without, sacrificing productivity.
Yeah, virtual meetings are a game changer these days, and cloud-based collaboration tools let teams work together from anywhere. Having a clear travel policy can also save a fortune. So encourage virtual meetings whenever possible. Prioritize economy flights, negotiate corporate rates with hotels.
Exactly. Those savings add up quickly, especially for businesses with frequent travelers. And don't forget about outsourcing those non-core administrative tasks. Things like bookkeeping, payroll, social media management. Specialized providers can often handle those things more efficiently, and it frees up your team to focus on, their core competencies.
Right, so it's about working smarter, not harder. Okay, final act in our expense review. Fixed versus variable costs management. What's the key to finding that right balance?
Well, fixed cost, things like rent or salaries, they stay pretty much the same no matter how much you're selling. Variable costs like raw materials or shipping, they fluctuate with your activity level. The key is to optimize that balance so you can be as adaptable as possible.
So sometimes it makes sense to reduce those fixed costs, like maybe to downsizing your office space or renegotiating a lease.
Exactly. It's about being flexible and strategic. What are some key considerations when deciding whether to outsource something or keep it in-house?
Yeah, that's a tough one.
It is, you have to weigh the costs and benefits. Things like the expertise required, the volume of work, the potential for cost savings. Sometimes outsourcing gives you access to specialized skills and technology that you just couldn't maintain in-house. But other times, it might be better to keep certain functions internal to maintain control and quality.
It sounds like a balancing act.
It is. You need to analyze your cost structure, your business goals, and of course the market conditions to be the best decision.
Right. There's no one-size-fits-all answer.
Definitely not. Cost control is an ongoing process.
Yeah.
You need to constantly review your expenses, identify areas for improvement, and always be open to innovation. That's how you stay ahead of the game.
Okay, so we've covered a ton of ground here on optimizing labor costs and reviewing expenses, but there's so much more to explore, especially when it comes to, strategically allocating capital. Where do we invest those resources to really fuel growth?
You're right. Now that we've looked at ways to free up resources, let's talk about where to put them to work, making those smart decisions that drive growth and innovation.
Stay tuned for part 2 of this deep dive, where we'll uncover even more strategies for making your business leaner, meaner, and more profitable.
Welcome back to our deep dive into capital allocation and cost control.
We just explored ways to optimize labor costs and review expenses, really getting a handle on how to free up resources within a business.
Now let's shift our focus to the strategic side of things, capital allocation.
So we've squeezed out inefficiencies, found some savings now. Where do we put that money to work to really fuel growth?
That's the million-dollar question, isn't it? Capital allocation is all about making smart decisions on where to deploy your capital. It could be investing in new equipment, expanding into a new market, developing a groundbreaking product. The possibilities are endless, but the resources are not.
I imagine it's a bit more complicated than just picking what sounds coolest, though. How do companies decide which projects get the green light?
There are proven frameworks and techniques to help evaluate potential investments and prioritize the ones likely to give the highest return. It's about balancing potential rewards against the initial investment, considering factors like time risk and strategic fit.
Okay, so let's dive into those frameworks. What are some of the tools companies use to make these decisions?
One common approach is net present value (NPV) analysis. It's a way to calculate the present value of future cash flows, taking into account the time value of money. Basically, it helps determine if an investment is likely to generate more value than it costs. Imagine you're comparing two projects, one with a quick return but lower overall profit, and another with a longer timeline but potentially much higher profit. NPV helps you make an apples-to-apples comparison.
So it's not just about how much money you make, but when you make it interesting. What other methods are out there?
Another popular one is the internal rate of return (IRR). This tells us the discount rate that makes the net present value of an investment equal to zero. Think of it as the expected annual rate of return a project is likely to generate. If one project has an IRR of 10% and another has an IRR of 15%, all other things being equal, you probably favor the one with the higher IRR.
It's like comparing interest rates on different savings accounts, but for business projects. Makes sense. But I'm guessing it's not just about the numbers, right?
You're absolutely right. Financial metrics are important, but they're just one piece of the puzzle. We also need to consider the strategic fit market conditions and even our own risk tolerance. A project might look great on paper, but if it doesn't align with the company's overall goals, it's probably not the best use of resources.
Right, because chasing every shiny new opportunity could lead you down a rabbit hole. It's about choosing investments that support the long-term vision of the company.
Now let's look at some specific areas where companies typically allocate capital. Property, plant, and equipment, or PP&E is a big one. We're talking about those big-ticket items like machinery buildings, vehicles, the things that form the backbone of many businesses.
These investments are often crucial for increasing production capacity, improving efficiency, or even launching new product lines. Imagine a manufacturing company investing in state-of-the-art robotics to automate their production line that could revolutionize their entire operation.
Exactly. But these investments also come with significant upfront costs and require careful consideration. You need to factor in things like depreciating and maintenance costs, and even the potential for the equipment becoming obsolete. It's like buying the latest smartphone, only to have a newer, flashier model come out a few months later.
So it's about weighing the long-term benefits against the potential risks. What about investments that are less tangible, like research and development?
R&D is all about innovation. Developing new products, improving existing ones, exploring new markets. It's the lifeblood of any company that wants to stay ahead of the curve. Think of a pharmaceutical company pouring resources into developing a groundbreaking new drug. It's a high-risk, high-reward endeavor.
It's like venturing into uncharted territory. You might discover a hidden treasure, or you might come up empty-handed. But without taking those risks, you'll never know what's out there. What about mergers and acquisitions? That seems like a whole different ballgame.
M&A can be a powerful way to grow, whether it's merging with another company or acquiring a smaller one. You could expand into new markets, acquire new technologies or talent, or even eliminate competition. But M&A can also be incredibly complex and risky. Integrating two different company cultures, systems, and processes can be a major challenge. It's like blending two families. It takes time, patience, and clear communication.
And sometimes it just doesn't work out. You hear about those M&A deals that looked great on paper but ended up being a disaster.
Which brings us to a less glamorous but equally important area, debt reduction. This might not sound as exciting as investing in shiny new projects, but it's an essential part of responsible capital allocation. Reducing debt can lower interest expenses, improve creditworthiness, and give you more flexibility for future investments.
It's like paying off your credit card debt before splurging on a vacation. It might not be as fun in the short term, but it sets you up for long-term financial health. So we've covered some of the key areas where companies allocate capital, but how do we know if we're making the right decisions? How do we measure the effectiveness of our capital allocation strategy?
There are several key metrics that can help us evaluate the success of our capital allocation decisions. One important one is return on invested capital (ROIC). This measures how effectively a company is using its capital to generate profits. It's essentially a report card for your investment decisions.
So a high ROIC means you're getting a good return for your investment. That makes sense. What other metrics should we be looking at?
Another key metric is economic value, added EVA. This measures the value created in excess of the required return for the capital employed. It tells us an investment is truly generating economic profit, not just accounting profit. It's like aiming for a gold medal instead of just qualifying for the Olympics.
And then there's payback period, which tells us how long it takes for an investment to generate enough cash flow to cover its initial cost.
The shorter the payback period, the better, right?
Generally, yes. A shorter payback period means you're recouping your investment quickly and can start reaping the rewards sooner. But it's important to consider the payback period alongside other metrics. Sometimes a project with a longer payback period might generate a higher overall return in the long run. It's all about taking a holistic view. Capital allocation isn't just about crunching numbers, it's about making smart, informed decisions that align with the company's long-term goals and vision. And it's an ongoing process. We need to constantly monitor our investments, adapt to changing market conditions, and be willing to adjust our course when necessary. It's like navigating a ship through ever-changing waters.
Yeah.
You need to be aware of the currents, adjust your sails, and be prepared to change course when needed. Now that we've explored how to allocate capital effectively, let's shift our focus to another crucial aspect of financial management, budgeting and forecasting.
Budgeting and forecasting are essential tools for planning, controlling, and monitoring financial performance. They provide a framework for making informed decisions and staying on track to achieve our goals. Think of it like planning a detailed itinerary for a road trip.
You need to know where you're going, how you'll get there, and how much it will cost. And just like with a road trip, you might need to make some detours or adjustments along the way. But having a solid budget and forecast keeps you focused and helps you make informed decisions.
Exactly. Now let's dive into some of the key types of budgets companies typically use. The operating budget focuses on the day-to-day expenses and revenues of running the business. Think of it like tracking your monthly household expenses, rent, utilities, groceries, entertainment. It's all about managing the cash flow needed to keep things running smoothly.
Then there's the capital budget, which outlines planned investments in long-term assets like PP&E. You talked about this earlier with capital allocation. It's like deciding whether to upgrade your kitchen appliances, renovate your bathroom, or invest in a new roof for your house.
Precisely. And finally, we have the cash flow budget. This focuses specifically on the timing of cash inflows and outflows. It's like making sure you have enough money in your checking account to cover your bills each month. You don't want to bounce a check or get hit with overdraft fees.
Now let's talk about forecasting. This is where we try to predict future financial performance using historical data, current trends, and a bit of educated guesswork. It's like having a financial crystal ball trying to get a glimpse into what the future holds.
Forecasting can help us make informed decisions about pricing, production levels, inventory management, and even hiring. It's like a weather forecast for your business. You might not always be able to predict every storm, but you can prepare for the most likely scenarios and adjust your plans accordingly.
So what are some key things to keep in mind when creating budgets and forecasts?
First and foremost, be realistic. Don't set overly ambitious goals that are unlikely to be achieved. It's better to underestimate and overdeliver than the other way around. It's like setting a New Year's resolution. If you set the bar too high, you're more likely to get discouraged and give up. Start with small, achievable goals and build from there.
That's great advice for life in general, not just business. What else should we keep in mind?
Flexibility is key. The business world is constantly changing, so we need to be prepared to adjust our budgets and forecasts as needed. It's like driving in traffic. You need to be aware of your surroundings, anticipate potential roadblocks, and be ready to change lanes if necessary. And don't forget about communication. Budgeting and forecasting shouldn't be a solo endeavor. Involve key stakeholders from different departments to ensure everyone is on the same page. It's like planning a family vacation. Everyone needs to have a say in the destination activities and budget, or you might end up with a mutiny on your hands.
That's a great point about collaboration. Getting everyone on board is key to success. Now let's move on to another critical aspect of financial management, risk management.
We've allocated capital, created budgets and forecasts, and now it's time to prepare for the unexpected. Risk management is all about identifying, assessing, and mitigating potential threats to our business. It's about being proactive, not reactive.
It's like wearing a seatbelt while driving. You hope you'll never need it, but you're prepared in case of an accident. What are some of the steps involved in effective risk management?
The first step is risk identification. This involves brainstorming potential threats, both internal and external. It's like making a list of all the things that could go wrong. It might seem a bit pessimistic, but it's better to be prepared than caught off guard. Once we've identified potential risks, we need to assess their likelihood and potential impact. We need to determine which threats are most likely to occur and which ones would have the most devastating consequences.
It's almost like playing a game of risk roulette, figuring out which threats are the most dangerous.
The next step is risk mitigation. This involves developing strategies to reduce the likelihood or impact of each identified risk. It's like putting on your armor and preparing for battle. We need to have a plan in place to defend ourselves against each potential threat.
So we've covered a lot of ground today: capital allocation, budgeting, forecasting, and risk management. We've explored the tools and strategies that can help us make smart financial decisions, optimize our resources, and navigate the ever-changing business landscape.
But remember, financial management is an ongoing journey, not a destination. We need to continuously adapt, innovate, and strive for excellence in every aspect of our financial operations. It's like a marathon, not a sprint. We need to pace ourselves, stay focused, and celebrate our accomplishments along the way.
We've laid the groundwork and explored the key concepts, but now it's time to see how these strategies play out in the real world.
In the final part of our deep dive, we'll explore some real-world examples and case studies to bring these concepts to life.
Stay tuned for part 3, where we'll uncover the stories behind some of the most successful and not so successful financial decisions in business history. All right, welcome back to the final part of our deep dive. You know, we spent the last 2 parts really digging into the nuts and bolts of capital allocation and cost control.
We've covered a lot of ground.
Yeah. From those nitty-gritty details of optimizing labor costs and scrutinizing every expense to, those big picture strategic decisions about budgeting and risk management. Right. And we've talked about the frameworks and the theories, but now it's time to see how these things actually play out in the real world, warts and all.
Exactly, because there's nothing like a good real-world example to bring these concepts to life.
Absolutely. So let's start with a classic example of successful capital allocation: Apple's investment in the iPod. Remember back in the early 2000s, portable music players were, well, kind of a mess.
Yeah, they were clunky, expensive, not very user-friendly.
Exactly. But Apple, they saw a gap in the market, an opportunity to really shake things up.
And they went for it. Invested heavily in R&D, created a whole new product category with the iPod, and of course seamlessly integrated it with their iTunes platform.
It was a brilliant move. The iPod wasn't just a product, it was a cultural phenomenon, changed the way we listen to music.
And it wouldn't have been possible without those strategic capital allocation decisions.
Now let's flip the script and look at a company that, well, didn't quite make the right decisions. Blockbuster Video.
Blockbuster. Once upon a time, they were the kings of home entertainment.
Right, but they failed to adapt. They completely missed the boat on streaming services like Netflix.
They were clinging to their brick-and-mortar stores, those late fees, even as the market was shifting right under their feet.
It's almost hard to believe, looking back now, how quickly things changed.
Blockbuster's failure wasn't just about poor capital allocation. It was a lack of foresight, an inability to adapt to those changing market conditions.
A cautionary tale for sure. Speaking of adaptability, another company that comes to mind is Amazon.
Oh yeah, Amazon's a completely different story.
They've consistently reinvested their profits back into the business, expanding into new markets, acquiring those promising startups, developing cutting-edge technologies, cloud computing, AI, you name it.
They started as an online bookstore, and now look at them.
A global powerhouse.
Amazon really embodies that growth mindset, that willingness to take risks, experiment, and even fail sometimes.
But it's their long-term vision, that relentless focus on the customer, that's made them so successful.
They're always looking ahead, trying to anticipate what's next.
All right, let's switch gears a bit and talk about cost optimization. Southwest Airlines is a great example. They're famous for their focus on efficiency.
Oh yeah, Southwest, they've built their entire business model around keeping costs low.
No assigned seating, no fancy meals, just getting you from point A to point B safely and affordably.
And it works. Southwest has consistently outperformed their rivals, even during tough economic times. Their commitment to cost control has given them a real edge.
They prove that you don't need to be flashy to be successful. Sometimes simplicity is the best policy.
Absolutely. So I think these examples really highlight some of the key takeaways from our deep dive capital allocation. It's about making strategic choices that align with your long-term goals.
Right, not just chasing the latest trend or shiny object.
Cost optimization. It's not about cutting corners. It's about finding those efficiencies and eliminating waste.
And maybe most importantly, adaptability, being able to pivot and adjust to those ever-changing market conditions.
Couldn't have said it better myself. At the end of the day, financial management is about more than just numbers. It's about making smart decisions that support your overall business strategy.
And whether you're a seasoned executive or just starting out, these principles can really help you navigate the complex world of finance and ultimately make your business thrive.
So that's it for our deep dive into capital allocation and cost control. We hope you found it valuable. And remember, financial management, it's an ongoing journey. Keep learning, keep exploring, and we'll catch you next time on the deep dive.
See ya.